with regards to VALMIN, VALMIN is one of the, again, non-prescriptive codes that relates to the valuation of a mineral asset. Similar to JORC, there is the VALMIN code, which is Australian, and there are also international codes that are not Australian as well. There is a Canadian code called SIMVAL. There's a South African code called SAMVAL. They're broadly similar, much as JORC is broadly similar to the Canadian NI 43-101 Resources and Reserves Reporting Code. So VALMIN is a code, again a principles-based code by which companies report the value of mineral assets, and the value of mineral assets is usually reported at key events. Key events being in Singapore an IPO or obviously an RTO requires a VALMIN code compliant report. Mergers, acquisitions, material divestments, etc. may require a VALMIN compliant code. Successful due diligence does not necessarily result in the transaction occurring. Successful due diligence results in the right thing happening. And the right thing happening could be to not conduct the transaction. The right thing happening could be to change the transaction. The right thing happening could be to proceed with the transaction as it was envisaged, etc., etc. And there are many instances of transactions not proceeding where that was the right thing, where transactions being changed and that being the right thing, and of course where investments going ahead and that being the right thing as well. The multidisciplinary approach that I mentioned before can involve lawyers, accountants and geologists and engineers. However, it depends on the size and scale of the due diligence. It can involve an enormous number of parties in addition to those three groups. So due diligence requirements obviously vary depending on the type of mineral asset for which a transaction is being mooted. For an exploration property, the due diligence might be simple, and here for a producing property, the due diligence might be complex. Well, what would be the differences? For a mineral exploration property, the due diligence required might be over a tenement concession area only. There might not be any assets within the company at all, apart from the tenement concession area. So, for example, there might not be any plant and equipment. There might be very few employees. It's quite often that in early stage projects, it's quite often that there are no material contracts, there's no debt, there's no staff, and so really the fact-checking exercise that goes into an early stage exploration project, an investment into an early stage exploration project, can be light on. It can be checking the ground, and checking the ownership structure, checking the legals, and that can happen in weeks and costs thousands only, and can be done quickly. Alternatively, for a producing project, due diligence can obviously take an extremely long period of time and can be extremely expensive. If a company has lots of material contracts, if a company has lots of staggered and tiered debts, if a company has lots of equipment, lots of things to check, then obviously the checklist is far greater, far longer, and it's obviously a far more complex process. And indeed, such a process would also go beyond just legal, commercial and technical. For a very complex due diligence, there would also be perhaps political. There would also be perhaps community and social due diligence to be checked. There would be other things as well. What do we actually want to know from a legal perspective? Well, the first question there might seem a bit obvious and a bit silly and a bit funny, but sometimes the answer to that is no, or sometimes the answer to that is not necessarily in the way that it has been presented to us. The key things that we want to understand and have answered in our legal due diligence are those key questions there. But let's go back to what a tenement is and what a concession is. A mineral tenement or a mineral concession is a right to exploit. It's a right to exploit. It's not the ownership of the land. It's not the ownership of the ground. And most countries have varying stages and levels of those rights. So there might be a right that is an exploration right, and then that right grants you the right to drill holes, it grants you the right to explore, it grants you the right to walk around, drive around, map, and take samples. Very importantly, take samples from the ground. But of course that doesn't necessarily confer any economic right to you. That exploration right is usually then upgradable to an exploitation right, where the exploitation right then grants you permission to dig up the ground, transport what you've dug to a processing facility, process what you've dug into something saleable, transport that saleable product somewhere else and get the revenue for it. Provided that you're complying with the laws and you're doing the right thing, of course. Well, the legal part of due diligence is understanding how those rights in that country work. Understanding that those rights are transferable and conferable to you, if that's what the investment is. And understanding, or it could be understanding how those rights are going to affect you if something doesn't go quite right, if something doesn't go quite to plan, and you don't want to end up as the asset owner, but maybe you do. For example, in the case of a debt instrument, if you're loaning, if an entity is loaning money in, and for whatever reason the project doesn't go well, the security of the debt is the project itself, so it's a project finance linked product in some way, and that doesn't go well, and repayment is not possible. Well, then the lending entity ends up with the asset. Well, banks aren't mining companies, so how is that going to work? And indeed, is the project therefore then worth what it is you've lent the money for it? So those are the questions that need to be looked at and need to be fact checked in the due diligence process. Now, of course, there's more. That's just the short version of. Future permits is also something that's worth understanding in our legal due diligence. Future permits, for example, you may have the rights for exploration or exploitation for a mineral, for a commodity over that area, but what other permits are required? For example, if you want to build a processing plant and that processing plant wants to use water, do you need a water license? And if you do, how easy is that to get? Do you need electrical permits? Do you need working permits? Do you need employment permits? I mean, sometimes yes, sometimes no. Social license to operate is always something important, and the relationship of the project to the local community is very important to understand and very important to have understood by the potential investing party. So what do the local people think of the project? Do they want it to go ahead? What is their understanding of it? If their understanding of it is that it will employ everyone and it will make everyone's life better, that's one thing. If their understanding of it is that they'll all be relocated and they'll all be shipped out of the area and, told to go away, well, that's a different understanding of it. But the investing party having the knowledge of what the local community's understanding is of the project is important, because it might be different to what the project proponent's understanding of what the local community thinks. In the prospectus, in the IPO offer doc, there would be a statement of the name of the tenement, the name of the concession, the number of the concession, the size of the concession, so in hectares or square kilometres, but it's usually hectares. There would be its location, there would be surrounding tenements, that sort of information would be reported because it would be reported in the independent technical report, which is part of an IPO offer doc.
And then you hop on Google Maps and check that it's actually there, or then what?
Yes. I mean, that's not necessarily something that a retail investor would do on a regular basis. Shouldn't be required. But that's certainly possible to do. With regards to legal, I mean, you know, one would hope that the company's appointed lawyers have, you know, done their due diligence and thoroughly checked such issues.
Yes.
With regards to commercial due diligence, can the development of the tenement actually take place? So, okay, the exploitation right exists, and therefore, eventually, provided the feasibility study comes back good and the joint resources are okay, etc., yes, we can then develop the tenement. Well, yes, we can legally, and we might be able to technically, that's great, but are we actually going to make any money out of it? If we are going to make money out of it, what are the taxes, rates, rents, royalties, minimum expenditures, etc.? So with regards to that, bearing in mind that a tenement or a concession is not the land ownership, it is the right to exploit. Well, you have to pay for the right to exploit. So generally, concessions have rents which are paid in some way to a local government, and royalties which are generally paid in some way to a federal type government. Some tenements also have, some countries also impose what's called a minimum expenditure. So some countries say to tenement holders, as part of what comprises a tenement holding, they say you must spend a minimum amount of money on this concession per year. So you know, for a very large concession, you might have to spend a minimum $100,000 per year, for example. That is a way of the government extending a level of control to say, well, we don't just want people to come along and create hundreds of thousands of millions of hectares of tenements and then just sit on those hundreds of thousands of hectares of tenements and not do anything with them. If you have a minimum expenditure, then you know there's value being added or created along the way within the tenements. Financial encumbrances, committed contracts, that could be, there could be some sort of lien on the tenement or concession itself, or it could be within the company that owns it. If the project does not have resources or reserves, if it's a more greenfields project, if it's an earlier stage project, well, what do you think is there? That's because that's the rationale for investing. If there's no JORC resources, then we will be investing because we think there might be JORC resources or equivalent at a later point in time. Well, what do we think's there? If the answer is, well, we think there's nothing there but potential, sure, that's still something good to invest in if you're a believer in potential. But of course, there's just a different risk factor. There's just a different set of disciplines involved in assessing that. Infrastructure, a very important consideration, particularly for bulk commodities. So infrastructure is obviously a far more pertinent consideration for iron ore or coal than it is for gold or diamonds. If I have a gold or a diamond mine and I need to ship out my batch of gold or diamonds that I've just produced, then I can do it in a briefcase. If I'm a coal mine and I need to ship out the 100,000 tonnes of coal that I made this month, obviously I'm going to need a lot of briefcases. In what order do we do things? Do we do the legal due diligence first and make sure they own it, and then send a bunch of geologists and engineers to site to check everything? Or do we send the engineers and geologists to site first to check that there is something there that we even want to think about, and then check that they own it after? Well, the chicken and the egg question can be asked again and again. And I would think that prudent organisations progress all phases of due diligence in a stepwise manner. So a little bit of legal, a little bit of commercial, a little bit of technical. Phase 1 done, let's move on to phase 2. A bit more legal, a bit more commercial, a bit more technical, phase 3.